Really quickly, before this video starts, I just want to say thank you guys so much for helping me hit 1,000 subscribers on this channel. I've been doing these videos for quite a while now, and it's super awesome to hit that goal. We did it before the end of summer like I was hoping, which is awesome as well. If you want to support this channel so that I can produce more, in-depth analytical analysis of companies, produce more financial and investing videos, make sure to check out my Patreon. I'm going to link it in the description. I'll have some goodies there if you want to help support me as well. Anyways, I really hope you enjoyed this video. It's going to be a good one. During the 2008 financial crisis, many people panicked and lost money in the markets. Many lost their homes. You could even say some lost everything. However, there were individuals who took advantage of the panic and they benefited immensely. They bought homes while everyone else was foreclosing or selling. They bought stocks when many thought the market was heading towards ground zero, and they made decisions that most were too afraid to make. The 2008 financial crisis hasn't been the only time this scenario has happened. During the dot-com bubble, investors bought oversold stocks. During the savings and loans crisis, individuals who didn't sell off their portfolio would benefit in the long run. Even during the Great Depression, those who took the advantage of the situation became some of those prosperous later on. More recently, the pandemic has created another one of these crises. But to some, it was merely a new opportunity. So be fearful when others are greedy and greedy when others are fearful. This investment philosophy has been used by the likes of Warren Buffett as well as myself. This investment advice is not just a philosophy of mine, but it's also a main part of my strategy. I made incredible returns during the pandemic, but I'm not here to boast or show off the wealth I created. People who have the arrogance to boast their earnings generally are either lying, got lucky, and are usually not to be trusted. Intelligent investors are humble and emotionally stable. They take advantage of situations to create wealth for themselves, not to show off to others. That said, in this video, I'd like to show you one of my personal strategies for investing that helps me generate above average returns so that you can do the same. The strategy is straightforward and almost anybody can implement it if you learn just to do three things. Number one, you have to analyze. Number two, you have to watch and listen. Number three, you have to make connections. You have to connect the dots. The strategy probably seems extremely overly simple. You may be saying it's not even a strategy. Rather, it's just, common sense. But that's not always true. It's far too often people just do the first one. They just analyze, but they don't watch and listen for what's going on. Or they just watch and listen and get caught on some hype train and end up losing their money. And number three, they don't make the connections. And when they make their investment, they aren't confident in the investment that they're making. So here's my strategy. Number one, you need to analyze, as I said. Analyzing is a potential investment is extremely important. If you don't, you're gambling, not investing. I'll show you how to correctly analyze an investment in a second, but I'll also be making a more in-depth video about how to analyze a company. So make sure to subscribe, hit the bell notification for that video. It should be coming out very soon. Watching and listening is just as important. Rather than analyzing the fundamentals of a company and its balance sheet, you need to be aware of what is taking place now and in the future. This is why mathematicians don't always make great investors. They overanalyze, but forget to watch and listen. You never know what a CEO might say or what a politician might do. You need to be aware. Last but not least, you need to make connections. By doing number one and number two, you should be able to come to a conclusion. If you can make the connection, you're better able to be confident about your investment. These steps are extremely important in order to take advantage of a crisis and maximize your return on your investment. So how do you analyze? Well, there's some simple calculations you can do on a balance sheet to create future confidence in your investment. The first one is net asset value per share. It's something that Benjamin Graham did, who was Warren Buffett's mentor, not muffer. The simple calculation will help you understand whether the company is trading above or below what it's worth. It's also known as the liquidation value. So if a company is trading below it, then that means if you were to buy the company and liquidate it, you would generate a nice return on your money. So if it's trading less than this value, you may want to consider this investment. You also want to look at growth, not just revenue and profit growth, but I'll compare that growth to how fast the debt and costs are growing on this company. So net asset value per share, the NAVPS calculation, is total assets minus total liabilities divided by outstanding shares. That'll give you a price per share, essentially what the liquidation price is per share. So if this stock is trading at $5, but you do this calculation and it's $10, what is a 50% margin there from its liquidation value to what it's currently trading at, meaning that it's trading significantly below what the company is actually worth. Now, Benjamin Graham actually took it a step further. He did total current assets minus total liabilities divided by outstanding shares. Those companies who are undervalued on that level are much more difficult to find. I usually do the first one since I like to include real estate, some other solid investments that aren't always included in total current current assets. But you can do it either way, depending on how confident you want to be on your investment. Again, positive cash flow growth is what you also want to look at. Cash on hand growth is really important because if they can put away more cash and have extra cash sitting there in an account, that means they have more time or more room to grow. That means they're able to put cash aside, which is really good. And that also means that their savings allow them to potentially make moves in the future, acquisitions, etc. It's really setting them up for success if the cash on hand is growing. They're growing their earnings per share as well. This simply just means they're making more money per share over time. They're not losing more money or slowing the growth of their company. Assets are also growing faster than liabilities. Sorry about that spelling error there, by the way. If assets are growing faster than liabilities, that means their liabilities are either decreasing, which means they have less and less debt, which is great. Or if their assets are simply increasing faster than their liabilities are increasing, that means they're having more and more assets, whether it's, more people owe them money now, they have more cash on hand as well, etc., whatever it might be. These are all really important things. Again, I'm going to make a more in-depth video on how to analyze a balance sheet because there's so much to it. So if you want to see that, make sure to subscribe. I'll have that coming out very soon. I'll have a lot of examples. Now, watching and listening, especially helpful for companies who don't have a normal balance sheet. What about companies who may not fit that liquidation style investment, whose balance sheets are slightly more complicated? Well, for this, watching and listening comes into play. You need to research what is coming out for the company. For example, Tesla is growing rapidly, innovating, and taking market share. Despite the stock trading well above its liquidation value and its price to earnings ratio being astonishingly high, the stock price continues to grow since the stock is extremely desired. The company is innovating rapidly, and its investors are pricing in the future, not just today. AMD is another example of a company with a high PE ratio and is trading well above its liquidation value. But if you watch and listen, you'll notice it's outcompeting its competitors, innovating rapidly, and is also a desired stock to own. If you were simply just to look at the balance sheets of these companies, you might miss out on a very great opportunity. So, after you've analyzed and watched and listened, you need to make the connection on whether this is a good investment or not. How do you make this connection? Well, you need to assess the potential risk involved, your confidence level, and to analyze the company along with what else you learned. Once you've made the connection and have found the investment to be one you're confident in through analyzing and watching and listening, go ahead and pull the trigger, which means to make the investment. And then don't look at it for a long time. Although almost no one does this, I certainly don't. I check my investments fairly often. It's important to be so confident in your investment, you could quite literally forget about the investment, and when you come back to it, it will have generated a nice return, and you can be confident that that will happen. This is a pretty optimistic scenario, and it's important to stay on top of things, but the level of confidence is needed in an intelligent investment. So how does this apply to my returns during the pandemic? Well, the great thing about this strategy is it applies both during a crisis and not during one. You don't mean to make the switch because the same strategy during both scenarios. Being fearful when others are greedy and greedy when others are fearful, simply making a connection after you've analyzed and watched and listened. So here's a real life example. You need to analyze the companies and situation at hand. This is what I did during the pandemic. I analyzed certain companies such as Disney, Microsoft, Tesla, AMD, and Amazon are some of the specific examples that I actually personally invested in myself during the pandemic. So after I analyzed these companies, I realized that they could withstand a short-term downfall and would ultimately benefit from the situation. I was watching and listening. I was listening to the earnings calls. I was, paying attention to what CEOs were saying about the situation, what companies were putting out, messages they were putting about what was happening. And as I followed the news closely and watched the habits of friends/families to see how they were changing, I noticed many of them were watching more movies and shows. They're using computers far more often. They're using Zoom to video, etc. So they're watching more movies and shows. That most likely means they might have purchased Disney Plus. If they're watching a lot of Disney movies, that means Disney, which will eventually rebound from this pandemic, at least its parks and everything. If it has this really strong streaming service as well to go along with that, well, it's going to come out on top of everything. And I know that Disney, by analyzing its balance sheet, it has the cash on hand to withstand a short-term downfall. On top of that, I looked at Microsoft. More people are using computers. That means more people need Microsoft Office. Microsoft's cloud growth will probably grow. More people buying and using computers is generally good for Microsoft. So I knew Microsoft was a solid investment that, although it took initial hit from simply a market-wide sell-off, I knew that long-term, Microsoft would either A, return to where it was before, or B, benefit greatly from this pandemic. And sure enough, it has benefited greatly. Then I also looked at Tesla. Now, Tesla was a tricky one because I was saying, okay, aren't more people afraid to spend their money right now? They don't want to go out and buy a car. But Tesla has so much demand, it didn't even matter. They have so much demand, they were able to continue, and this pandemic actually gave them the opportunity to continue to expand and catch up on demand so customers aren't waiting as long when they order their vehicles. Overall, this hurt Tesla's competition, but it actually benefited Tesla greatly. So I knew Tesla was another one that became extremely undervalued, in my opinion, during the pandemic when it crashed to, I believe it was like $350 a share at that time. AMD was another one. More people using computers. I knew that the new video game consoles were coming out, the PS5 and the Xbox. I think it's Generation X or something, it's called something like that. I knew those were going to use the AMD chips. I knew that more people using computers means more AMD's going to have to produce more chips for them. They're innovating, coming out with new chips. This is an investment that I was very solid or confident in. Amazon is another one. I knew Amazon was not going to disappear because of the pandemic as more people stayed inside. I watched that my family ordered lots of things on Amazon. I noticed people were just ordering tons of stuff to their home, and I realized that Amazon was a great investment. Its balance sheet was also very solid as it continued to grow after announcing its earnings, and that's along with all of these companies. So after I analyzed, I watched and listened, I connected the dots. I realized that many of these companies, as I said, were undervalued or could benefit from the pandemic. So by entering into the market when everyone else was exiting, I was able to purchase shares at a very discounted price. To limit my risk, I invested in companies I both believed in and knew would be around long term. Anyways, thanks for watching. That is my strategy. It's extremely simple. It almost seems too simple to some people, since people are so used to seeing so many technical analyses, crazy graphs on charts. Sometimes simple is better. And when people overlook these simple strategies, they can overanalyze and overdo their strategies and actually lose a lot of money. So to have this simple strategy that both works during a crisis and outside of a crisis, and it's the same, it doesn't change, is very effective, and it makes you to be a very confident investor that can generate extremely good returns. Again, thanks you for watching. Please subscribe. Make sure to check out these videos as well as follow on Twitter for at StockerFinance for more information. I'll see you guys in the next video with some analysis videos coming out very soon. Peace out.